I think the volatility, well, first of all, it's friend of the long-term investor. So if you were in there buying early this morning or pre-market, you're in good shape. But I also think that the Michigan numbers were more important than the jobs numbers. They weren't really, the jobs numbers, that is, as robust as the headlines indicated. So you saw, the return of UAW and screenwriters. You saw a lot of healthcare jobs, but manufacturing jobs were down. So I think that the initial reaction was ill-informed. Remember that it's the algorithms that are reading the headlines, driving volatility. But the Michigan numbers were actually, I think, quite encouraging, and I'm loving this rally.
Those pesky algos, and I have it on good authority that they have financial clout. The 1 year inflation expectations come in at 3.1% on the Michigan numbers. Now that is perhaps the more significant piece that the bond market will look towards, isn't it?
Yeah, and hugely better than the market was expecting.
4.3 was the expectation,
Right.
Previously 4.5%.
Yeah. So you're right, Manus. I think one of the things that we've been arguing is that inflation, yes, it is coming down. I think what the disconnect between most people and us, the financial community, is that it may be coming down, but there are still embedded very high costs. I think so. That's why I think the Michigan numbers are so powerful, because there seems to be some realization that we're at the end by the consumer. Maybe they can, sort of absorb some of these higher prices.
Can I just say, as a recent transplant to your fine country and your esteemed city, my gosh, it's expensive. And I've come from one hellish expensive city, from Dubai, from the Middle East, on food, on booze. And there was no tax. There was no income tax there. I mean, I'm being taxed within an inch of my life. How strong? Where do you want to be in this economy? Because is this the immaculate disinflation? Is this the soft landing? Oh, these sayings are so awful. But how do you position for it? Because it doesn't look brutal or hard.
Well, Manus, I think we were talking pre-show that my analogy is I was alive in the 90s. And
As was I.
And I was managing billions.
I was too, just for the record. Let the record show.
Barely. And I was managing billions of dollars. And this feels a lot like that. So you have what I would call, and some are calling the fourth industrial revolution, or a super cycle in technology, digitization, generative cloud, computing. I mean, just look at Broadcom's numbers last night, and that's the poor man's NVIDIA. So if you look at that, and you say, okay, we had higher inflation, we had interest rates that were 5 to 8% in the 90s. We had an inverted yield curve, what was called then a soft landing. I'm not predicting one this time. We had a war, we had a recession at the beginning of the decade, and yet the NASDAQ was up over 8%. The Dow and the S&P were up over 400%. So I think stocks can continue to do well in here. The surprise is going to be earnings, I think, for most investors. And I think what we're seeing now is that, for the most part, the market's not listening to the Fed anymore, which I've said, and we don't need to debate it, has a credibility.
The rates market hasn't been listening to the Fed all year.
Has a credibility problem for sure.
Yeah.
So I want to be in overweight technology. I want to be overweight industrials because the PMIs are bottoming.
When you're looking at technology, though, is that predominantly within the Magnificent Seven and Friends, or you're looking at kind of more of a widespread rally within tech?
Yeah, so the companies that are, so our investing theme is old economy companies, Bailey, that are pivoting to digitization and embracing it, and then the companies that are providing those tools. So our biggest holdings in technology would be Microsoft, Palo Alto Networks, ServiceNow, Broadcom. I'm probably forgetting half a dozen of them, but the names that are going to drive this next super cycle. I'm not interested in Meta. We own a little bit of Google, but those are in some ways glorified ad companies. We want the ones the companies that are driving it.
It's interesting because when we've had a variety of people in through the morning time talking about the propensity for Mag 7 to deliver outsized returns in 2024 may well be more challenged, and perhaps you want to go a little bit more for breadth. At the end of every year, I'm waiting for the Goldman's report to come out on buybacks or whatever, but this is where I want to get your sense. Buybacks are incredibly important. Apple intermittently do it, and we spend the whole day gorging on Apple's buyback and bond issuance to fund it and whatever. But where will buybacks put a floor in this market?
Absolutely.
And to what extent?
Took the words right out of my mouth.
It's from the script.
We secretly have notes.
Did I say that?
Oh, did I read that?
You said it better. Yeah, I think clearly they are going to. And one of the things that drives, and will continue to drive that, is the insatiable appetite that the shadow banking system has for corporate bonds. But if you just look at the Mag 7, it's not all of them, I think it's 4 or 5, they're going to issue $100 billion in share buybacks over the next year or two, or claim 100 billion, however you want to say that. I think that's what we saw in 2020 and 2019, and that's what we're going to continue to see in 2023. It is, and Apple's a big chunk of that. So you just need them to do what they say they're going to do, and so I think you buy the dips in technology. And I know there's a lot of people that are saying the tech trade is over. I just don't agree. I think they're ill-informed.
Well, I'm looking at kind of the catch-up trade, if you will. We're seeing the equal-weighted S&P catching up really since that November, late October bottom. How do you see that playing out in different areas? You mentioned industrials. Is that a place that you're continuing to put cash to work? What names do you like within the industrial space?
Yeah, so we like the ones that are automating. And I would say broadening out is great for portfolio managers because we have to be diversified, Bailey. So you can't put all your eggs in the technology basket. But, Carrier is one of our largest holdings in industrials. You saw it pop today on the sale. We also like Illinois Tool Works. We have exposure to Emerson Electric, and we actually have exposure in a different portfolio to Honeywell. So it has done not nearly as well as those names, but I think you still want to be in the short cycle of industrials, and then broaden out in. We have a market weight in healthcare. We have a market weight in financials, and an overweight in consumer discretionary. So broadening out is great. We were adding risk back into our portfolios in October of 2022, so we were adding to technology when the last death knell was issued, and we will continue to do that as we have the opportunity.
You mentioned consumer discretionary. The chatter's died down a bit, but what's your thought on kind of this Ozempic trend, and is that really going to reshape the entire economy and how people spend?
I don't think so, Bailey. I mean, I was around when we had fen-phen, and for a while it was great, and then all the side effects showed up, and I just don't think there's enough data. And I was just in the Midwest, and they have not gotten the Ozempic message, or the memo. So I think it will have an impact mildly, but I don't think it's going to hurt these companies like the initial reaction indicated.
And then just very quickly, we have a big take story this morning talking about Hermes having delivered 1,000% return since they batted away LVMH. Do you feel confident at all in taking some of the higher, let's say, the premium names relative to Hennes is a very European number. I'm learning as I go here in terms of what's big on the high street. Anything? Are you still comfortable taking any of the higher value luxury names?
Yeah, I mean, we do own Lululemon, and it looks to me like it turned around this morning when I was walking over here, and that's because they are a premium provider, and they've delivered, and they're adding to
481.16 up $16.
Yeah, I'll take it. And then we own Nike. So that's another name in that space that can be high.
With those,
somewhat high end.
With those though, like again, somewhat high end, definitely areas that are targeted to the younger generation, people who want to spend. When you look
That's
at
you,
that is me. I know. I don't want to. For people not
and the
streaming
baby
on
boomers,
YouTube,
we're spending like crazy.
I'm technically not a baby boomer yet. Go on.
We've got about 30 seconds, but how are you thinking about kind of the strength of the consumer into 2024, just given how much the younger generations have been putting on credit card debt and things like buy now, pay later?
Yeah, great for American Express, by the way, which we also own. So I would say that people spend when they're working, and they spend out of their net worth. Americans have $154 trillion in net worth, half of which is with my generational cohort, which is the baby boomers. They are going to continue to spend. They have no debt. For the most part, and they will continue to spend. So I think high end is good. We're looking at LVMH, looking for an entry point, and I'm going to run over to Hermes now that you reminded me.